Yo, what's going on, everyone? So I'm back with another video. In today's video, we'll be talking about risk management and the capital raising in trading. So a lot of people have been asking me this question for months and months and months. My students been asking me this. Well, my students already got hands-on experience with me showing them and walking them through risk management and raising capital in trading and how to preserve your capital in trading and how to be profitable even if you're not making hundreds and thousands of dollars a day, like you see on Instagram or YouTube or any of those things of those nature. But this is a highly requested video, so I want you guys to pay very close attention because I know there's not a lot of traders out here in this industry that's making videos on this. So this video is going to be very different. It's going to be very boring, but you have to pay attention if you want to be profitable and you want to be in this game for as long as I've been in this game. I've been trading since I was 15 years old, roughly 8 to 10 years. So the first thing you guys need to understand is the simple mathematics sides to trading. Okay, so let's say you have $1,000 in your account, right? Cool. Think of $1,000. Let's whip out you guys' calculators because I know some of you guys, it's okay. You have $1,000 in your account, right? For proper risk management, if you have $1,000 in your account, logically, you should not be trading or over leveraging. You're trading with the full 1,000 or even 500 or 800 or anything like that. That is called over leveraging because that is more than 10%, 5%, 15% of your overall account. If you're trading with $800, right? Let's just say $800. That makes up roughly what? 95%, 85% of your account. Are you following me, right? So that is called over leveraging. If you guys do not know what over leveraging is, then I don't even know why you're on this video. Because 9 times out of 10, you're on this video because you blew your account. You blew your live account. You're blowing prop firms. You don't know how to manage risk. You don't know how to raise capital. You don't know how to be profitable. So you have $1,000, right? So with $1,000, if you guys have $1,000 in your live account, or you have a 50,000, just anything in general, let's just do simple math. If you trade per trade, you risk $10. Let's say per trade you risk $10 on a $1,000 account, right? So let's do $1,000 divided by 10. That means you will have to lose 100 trades to blow your account. Okay, that's a little ugly, but you guys are following along for the $10 you risk on your account, right? Let's go to $50. Let's do 1,000 divided by 50. That is 20. You have to lose 20 trades if you're risking $50 per trade to blow your $1,000 account. Okay? For the $100 account, it's very simple. No calculator needed. For the $100 risk per trade, you have to lose 10 times to blow your entire account. So now that we have this in front of us, right? It is very simple to move forward and be like, okay, I should not be risking, or I should not be, if I see my stop loss is $150, right? You're over leveraging because that's more than 10 that's more than 10 to 15% of your account. If you're down $250, $300, or you lose a trade and is at, I don't know, $800, you're over fucking leveraging. So if you have $1,000 account, you got to pick between which one of these you want to risk per trade. It can be $50, it can be $100, it can be $10. But you need to know at the end of the day, if you're risking $10 per trade, the moment you get down $10 and you risking, the moment you get down $10 and you're risking $10 and you lose a trade, you got to realize you have to lose 99 more times to blow your entire account. What most of you guys do is brain dead. Most guys do is get your account clipped. You'll risk, or let's say hypothetically, let's scale this down a little bit. You'll lose $250, right? Out of your $1,000 account, and then you will not change anything about that. You're like, okay, I just let my losers run. I just lost $250. You're over leveraging. You cannot do this 5 more times because your account will be blown. Are you following me? You're over leveraging. Okay, so you should not be risking no more than 5. Let's do 5 to 15% of your account. If it doesn't matter, and this does not matter if you have $1,000. This does not matter if you have $20,000. You should not be risking 35% of your capital, 50% of your capital. Whether you got $10,000, $20,000, $10, $100, $1,000. Just for the beginners. Until you get more experience, then this can increase. Then this can increase to 20%, 25%. You know what I mean? But just for you guys to get comfortable and get profitable, start with at least 5 to 15%. You should not be risking more than 5 to 15% of your account to 20%. Just in that ballpark range. I'm gonna even, just for you guys, because I know some of you guys scout. I don't even like. Nah, I'm gonna keep it at 15. I don't even like fit. I don't even like 25% for you guys. That's too. You guys be getting too carried away with yourselves. Okay, so you guys are following me. Which realistically, this right here, if you lose 100 times risking $10 per trade, something is mechanically wrong with what you're doing. Fuck the strategy. Fuck the YouTube videos. Fuck the Instagram reels. Fuck everything that you see online. You need to go back to the drawing boards. You need to go back to the basics of trading. You need to understand candlesticks, wicks, market structures, trends, swing highs, swing lows, pips, macros, micros. You need to understand every single thing. Every single thing. You need to go back to the fundamentals. You're way too far ahead. You tried to skip level 1, 2, 3, 4, and 5, and you're trying to get to 20. You see what I mean? You need to go back to the drawing boards because it's so hard to lose 100 trades. I don't even think I have lost 100 trades in the last 5 years. I will bet you my last dollar I have not lost 100 trades in the last 5 years. I'm guaranteed. I've only been trading for like 8 to 10 years. Trust me, it's very hard to lose 100 trades, especially in a row, because Lady Luck eventually is going to bend to your will. Eventually, you're going to win a weak ass trade you shouldn't have won. If you lose 100 trades, something's mechanically wrong. Okay? Now, let's take that same mind frame. If you lose 10 trades, something is still wrong, mechanically wrong, but at the same time, you just may be over leveraging where you keep blowing your $1,000 account. You may think like, fuck, I keep blowing my accounts. Fuck, I keep blowing my accounts. You might just be over leveraging because you're not taking this 5 to 15% rule. You may be just losing $250 here, $100 here, $100 here, $250. If you blow 10 trades, you're somewhat still doing well, but you may just be over leveraging. You may just be clipping your account so much and so fast to the point that you don't even allow yourself to survive another day. Does that make sense? Like, you guys be risking you go down $500, $350. You only have $150 left. Blow that shit too. Now you out the game. Now you cannot continue playing the game. The goal with trading is to be in this game as long as possible. It's not about winning trades. It's about preserving and raising capital and preserving your capital that you already currently have. And I'm going to teach you guys that later on in this video. But just for the simple mathematics side of this, you see how this look. If you're risking $50 per trade, you have to lose 20 times, which is so fucking impossible. Just like the $100. To lose 20 times in a row, that is so hard to do. Like, it gets to a point when you're losing 4 or 5 trades in a row, you need to stop and realize, what the fuck am I doing wrong? But it all starts with how much you're risking per trade. Because you can survive losing, let's say this over here. Let's say if you're risking $10, you can survive losing 35 trades, 30 trades, because you still got 70 trades left. You're still good on your account. You know what I mean? You still roughly flown, let's say, you're still good. You're still like $800, $900 in your account. You're still good. You didn't blow your account. You still could survive and trade another day. You guys be clipping your entire $1,000, or you be down to $100 where it don't even allow you to even make real money anymore. It don't even allow you to raise true capital. Now you got to trade with 0.1 lot size. Now you're getting a 100 pip move is 15 cents. Like, you see what I mean? Like, you guys, the main goal is you want to be able to win and fight and live to fight another day. Like, honestly, you guys be clipping yourselves way too fast. It will take you 100 losses. By the time you take 35 losses, you're like, damn, I only have $800 left in my account. $900, $800 left in my account. Like, why did I lose 30 trades? All right, let me reevaluate, but I still have $800 left. I'm still available to play the game. I'm still available to take a break, 2-3 day break, maybe a week break, come back the next week stronger, analyze why I lost these 35 trades, and continue playing the game. I didn't clip my whole $1,000 because I'm over leveraging 25% of my account, and I'm losing $250 per trade. You're not doing that. Are you following me? Even a $100 one. You know what I mean? And most of you guys aren't even disciplined enough to be down $100 and be like, okay, I'm just get out the trade. You be like, it may reverse. That's a whole nother video about discipline and psychology. But this is all important. You must be comfortable and realize, what are you comfortable losing if you have a $1,000 account, $10 account, risking 5 to 15% just starting out until you become comfortable and profitable, until you see green day after green day after green day for at least 90 days. This is what I want you guys to do, is risk 5 to 15% of your account and proper risk management. Now let's get into the meats and grits of the charts of how this is shown on the charts. How do you preserve capital? How do you raise capital? Okay, let's just hypothetically take the same scenario. Now you have the numbers, how many times you can lose, how many times they allow you to keep fighting and win and live another day. Like, are you following me? On a $50 account, or you risking $50 per account, per trade, you can't lose 20 times because you'll blow your $1,000 account. You can lose 5 times, you still be in the game. You can't lose 20. On a $100 account, you're tiptoeing. You lose you lose 3 trades, you're in your feelings. You lose 5 trades, like fuck. It's beginning to happen again. I'm beginning to slip up. I was winning a couple trades. Oh no, here we go again. Okay, so for raising capital, this is how it's gonna look. Now you guys understand the mathematics side of this. This is how it's gonna look on the charts. I'm gonna teach you guys exactly how to be profitable, how to make it so impossible to lose a trade. All right, let's just take a random chart here. I want to make it a little bit more cleaner. Let's take this chart. Let's erase all drawings. All right. Watch how I do this. If I was looking for buys, right? Let's say I just mark this level up. I'm looking for buys here. Let's just hypothetically, for the example, don't be literal. Don't go to this actual chart and be like, oh, you're looking for buys. No, calm down. We're learning about risk management and raising capital and preserving your capital. Because the person who has poor ass risk management, but wins big trades every once in a while, they're gonna fizzle out and they're gonna burn out and they're not gonna be in the game years to come, like the person who is preserving a capital, but they only win at $100, $50, $200 per trade. They're more disciplined, they're more consistent, they're doing the right mechanics to be in the game long time. Versus the guy that's just trying to full pour his account and looking at YouTube videos and Instagram reels, even mine's, $20,000 days and stuff like that. So let's say you was in buys, right? Your first TP, just no strategy aside, if I'm only looking at this, your first TP should be here. Your second TP should be here. Your third TP should be here. Well, technically your third TP should be here, right here. Then your fourth TP should be here. Why am I doing this? Because I'm showing you an example of where I will be taking my profits. But for the good example of fair game with for the example, I want you guys to, do you guys know this game right here? That you guys see at the fair or anything like that? We got to throw the ball in the hole and you get like 100 points, 500 points, $1,000 points. And then sometimes like some of these games at the fair, it has like the machine going left to right or anything that, like, do you guys know this game I'm talking about? I think it's like, it's not this one. It's very close. It's like right in front of you. But essentially while I'm pulling up this picture, it's almost like, yeah, I think it's like this. It's this one right here. The reason I'm pulling up this picture is because when it comes to risk to reward and when it comes to managing capital and risk, it's all about what are the probabilities to happen. Most people say, I want to target a 1 to 4, 1 to 4, 1 to 4. The probabilities of a 1 to 4 happening are a lot slimmer than a 1 to 1. I know a guy that only trades 1 to 1. You have to get a 1 to 1 before you get a 1 to 2. You have to get a 1 to 1 before you get a 1 to 4. It has to become a 1 to 4 first, or 1 to 1 first before it becomes a 1 to 4. Does that follow you? And a 1 to 1 is equivalent to this fair game. A 1 to 1 is equivalent to you rolling the ball into the 10 area, or you're trying to drop it in the 5, right? Let's just use this example. This is a lot cleaner, right? Or even this one. A 1 to 1 target is equivalent to trying to hit it in the 31. You're standing right here on the side. You're like, I don't want the 30. I want the 101. I want the 51. The ones that's harder to hit. A 1 to 1 is more guaranteed to happen because it is so easy. It's much easier. It is so much easier throwing your beanbags in a 5 than it is trying to throw in a 20. This is almost like almost 100% to like a 91% throw rate right here. If you try to throw it at 5, 5, 5, 5, 5, 5. Yes, you'll have to win more to equal up to this one throw, but it's more likely to happen. So let's take the same example. Let's say we go here to here. This is a 1 to 2, but let's say a 1 to 1 is right here. This is a 1 to 1. I don't like this. The arrow is too ugly, mate. So we have this 1 to 1 here. If you was in a buy position, let's say your stop loss is below here, yada, yada, yada. We don't have a level. A 1 to 1 is guaranteed to happen. For price to move 10 to 15 pips is way more likely to happen than price move 100 pips. A 1 to 1 to 10 to 15 to 20 pips is way more likely to happen. You can even look on the charts. 1 to 1, 1 to 1, 1 to 1, 1 to 1, 1 to 1. Price moves 10 to 15 pips, 10 to 20 pips more likely than it is to make these big ass moves like here, 100 pip move, almost a 300, 200 pip move. Like you don't even see that anymore. Well, you see it over here. It's spread out. It's more likely to happen. So think of a 1-to-1 like throwing it into this 5, throwing the beanbags into this 5 hole. Is 90% chance that you're gonna have the 1-to-1 here. You see a 1-to-1 here, 1-to-1, 1-to-1. Even on the sell side, a 1-to-1 is more likely to happen. So your first target will be a 1-to-1. And once price is at a 1-to-1, what you guys are gonna do is take 10 to 25% profit off the table. So if you let's say you're up, hypothetically, let's say you up $100, you're gonna take 10 to 25% out that $100 when price is at a 1-to-1. And what you're gonna do is you're gonna move stops to break even. Actually, no, you're just gonna move your stops up. If you was gonna lose, let's say $100, you're gonna move it to $50. And then once price gets to a 1-to-2, which a 1-to-2 will be this $10 hold, you was like, okay, worst case scenario, if price reverse, I'm still profitable. Oops, good email. Worst case scenario, I'm still profitable. Okay, so once price gets to a 1-to-1, you're gonna move your stops to break even. And you're gonna take 10 to 25% profit off the table. So if you're up $200 or you're up $100, you're gonna take 10 to 25% off that initial position. It's called taking partials. And you're gonna move stops to break even. Why are you gonna move stops to break even? Because worst case scenario, if price is going up and it hits your 1-to-1 and decides to go down, guess what? You still pocketed $50 to $100 or whatever your profit is from this 10 to 25%. Meaning you have a winning day. You have a green day. Now, if price continue doing what you wanted to do, go to the 1-to-2, which is equivalent to the $10 hold, or the higher hold, which is a lot less probability. That don't mean it's zero. It's just lesser than here. Throwing it in the 10 hole is still pretty big, but it's not as easy as the 5. So let's say the 5 is almost a 98%. The 10 is almost a 80%. It's still high probability. So let's say price move to a 1-to-2. So not only is all risk being off the table from the original 1-to-1 and you go and break even, you already solidified profits. So you already had a winning day, a profitable day. Now anything else that runs is just more money on the table. So once price get to a 1-to-2, you're going to rinse and repeat. Once price get a 1-to-2, you're going to take 10 to 25% off the table again. Right? Now you're pocketing more money, but risk being off the table at a 1-to-1. You been took risk completely off. You been profitable and took all risk off the table. You been had a winning and a profitable day. Now if price decides to go to a 1-to-3 or 1-to-4 or start to do all the good things that we want to do, it runs for 200, 300, 1,000 pips. You know, it hits this $20 hole. Not $20 hole. There's this 20 point hole. It hits this $100 hole. It just continue to run. Guess what? It's still more profit on the table. And in each level that price stops by here, 10%, 10%, 10%. Or you can go 25%, 25%, 25%, 25%, and so on and so on and so on. But the main thing I'm trying to get and rail inside you guys' head is probabilities. A 1-to-1 and a 1-to-2 is more likely to happen than a 1-to-3 and 1-to-4, 1-to-5, 1-to-6, 1-to-10. It is a higher chance, just like throwing the ball into the 5 and the 10. A 1-to-1 and 1-to-2, 1-to-3 is more easier to throw the beanbag in these holes, aka a 1-to-1 and a 1-to-2, than it is to go for a 1-to-3, 1-to-4, 1-to-5, 1-to-10. A 1-to-10 is like this $100 one, and it's a tiny little hole. It's much harder to do that. You guys are immediately going for, oh, I'm just gonna go break even once I get a 1-to-3 or 1-to-4. Basically, you're saying I'm gonna go break even, and I'm gonna take my profits once I get it in the $50 hole. Even though it's super hard to get in the $50, it's so tiny and it's in the middle. It can slide down to the 40. It could kind of touch it could do whatever it wants to do. It's a much harder throw. No, once price go to a 1-to-1, you're gonna move stops to break even. You're gonna take 10 to 25% profit. Once price go to a 1-to-2, take 10% profit, or 10%, 10 to 25% profit off the table, and so on and so on. And as it's moving up, once it goes to a 1-to-3, 10 to 25% profit off the table, leave the rest running, and so on and so on and so on. This keep you something we call consistent. You are a consistent trader. You are a profitable trader. Because worst case scenario, by the time price get a 1-to-1, which is a 90% chance of happening, a 1-to-1, 10, 25 pips is a 1-to-1. It's more likely to happen. You telling me if you go to the fair right now, your ass can't hit the beanbag, throw the beanbag into this 5-point hole 100 times? You telling me if you throw the beanbag in this $5 hole or this 5-point hole 100 times, you telling me 90% of you telling me 90 out of 100 shots you're gonna get right? Yes, because it's easy. Versus I tell you, okay, out of 100 shots, 100 throws, try to throw it into this 100 point hole. It's gonna be much harder. You're like, oh shit, out of 100 times, like maybe 25, 35% of the time it goes in. But I know for a fact it's almost guaranteed with the 5-point and the 10-point. Are you following me? A 1-to-1 and 1-to-2 are more likely to happen than a 1-to-3, 1-to-4, 1-to-5, 1-to-10. So as prices going up and prices going down, you're taking your profits. You're removing risk off the table by going break even. You don't even got to go break even on a 1-to-1. You can go break even on a 1-to-2 because it's more further away from your entry. But the main thing is taking risk off the table and then taking your profits. Because worst case scenario, you be like, damn, I made money, but I didn't make my full position. Because what tends to happen is what Price did here. Price bought up to a 1-to-1, then a 1-to-2. It didn't go to a 1-to-3, 1-to-4, or 1-to-5. And it went back down, sold back down, took you out the trade. But guess what? You still made profit off the 1-to-1 and the 1-to-2. Do you see this? You're still okay. Price didn't even go fully into 1-to-3 that you thought, the 1-to-4 that you thought. It just went to a 1-to-2 and just reversed. But guess what? You still took 50% profit off the table, or ever how many percentage that you was taking as it was going up, and then you went break even. So worst case scenario, it did what it did. It went up and then go to the 1-to-3. It sold back down, took you out of trade. You still make money that day. You still was profitable. You're not gonna be mad because you make money that day. The only thing you're gonna be mad about is not making enough money. But that's being greedy, and that is a whole different mental psychology and money psychology in trading that we gotta talk about too. Okay. That is the main goal, is to preserve your capital and be in this game for a very, 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 very long time. And that is the only way you're going to be able to do it. Are you following me? Okay. So don't over leverage your account. Make sure you guys take your profit. Oof, this is a little ugly. See if you guys can screenshot this. Don't over leverage your account. Risk 5 to 15%. Starting out, risk 5 to 15% of your account, and then gradually go up. Go to like 18%, 20%, 25%. Once you become profitable, once you start seeing consistent wins of you not blowing your account, you're not constantly losing trades, you know what you're mechanically doing right, then you can start risking more per trade. But for now, only risk 5 to 15% per trade until you start building that consistency. You start seeing green days. And also, when you're in a trade, always target a 1-to-1 first or a 1-to-2 first, and then move your stops to break even, and then take 10 to 25% of your initial take partials, your position, off the table. Because worst case scenario, you made money. Worst case scenario, it goes in a different direction. Guess what? It takes you out of trade. You didn't lose any money. You just made money today. And you don't even see another position on the chart. You just, okay, I made money today. And consistency compounds. You may not think $100 or $150 is a lot of money, but most of you guys only make that work in the job. You have to be getting paid like $15 to like, I think $20 an hour for what, an 8-hour shift, to be making like what, 150 plus an hour, which most Americans don't. So if you do 150, there's 5 trading days in 4 weeks. That's $3,000 a month, and that's bare minimum. We know your trade is not going to always just go to a 1-to-1 or 1-to-2 in reverse. It's going to ride for a 1-to-3, 1-to-4, 1-to-10, 100 pips, 1,000 pips. You know what I mean? That's just bare minimum. That's $3,000 a month passively, and you're consistently making that. But that's pretty much all I have for you guys today. I hope you guys enjoyed this video. If you guys have any questions, make sure you guys comment down below. Whether you guys are seeing this on YouTube, whether you guys are seeing this in my community, make sure you guys just rewatch this, really colloquialize this. Don't just say, oh, I understand, blah, 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 and then immediately get on charts and just do where the fuck you want to do. No. Make sure you guys really understand that it is not about making money. It's about preserving your money. I'm not saying saving, preserving your capital. That's how you raise capital in this game and be in this game a long time, because consistency compounds. Rome was not built overnight. Brick by brick, inch by inch, you will be successful in trading. If you follow this blueprint, you follow this risk management blueprint and this capital raising and preserving blueprint, I promise you, all my students in my mentorship program are profitable because they follow this. Where they started with $200, where they started with $1,000, $10,000, where they started with a prop firm. They have followed this blueprint to the T, and all of them are profitable and only sit short months. But walk with truth, walk with power, and may God favor you.